So if you're a company, how do you raise money?
On investors.
Okay, so if you're having investors, you have to convince them with what they're investing in, right? So there are really two ways to invest. You can either offer equity in the company. So you now own a certain percentage of the company, usually in the form of stock or ownership certificate of some type. On Shark Tank, they talk about, I'll give you this much for this much of a share, right? That's the share they're talking about. Or you can issue a debt, you can take out a loan. But if you take a loan, then what you're really saying is, I'm good for this. I may have collateral on this loan, I may not, but let's talk about that loan process. In short-term debt, you usually get something like a demand loan. I will loan you this $20,000. It comes due when I say it's due, but no more than this far out from that. Or a line of credit, like a credit card. Home equity lines of credit work exactly this way. But when you talk about longer term borrowing, standard amortization procedures are usually only done for quote unquote short-term loans. So when you think about something like a mortgage, we think of a mortgage as a very long thing, but in one sense, it's actually a pretty short thing. And they're almost always done for quote unquote small amounts. How does the city of Pittsburgh raise money? How does the city of Dallas raise money? How does the federal government raise money? All right, if I'm looking at larger amounts, when I go to issue debt, I don't actually do it in the same way as taking an amortized loan. I create a bond, which is sometimes referred to as a debenture issue. This is the first place I'd ever heard that term. A bond requires some sort of payment to be made on a regular basis, an interest payment. But the interest payment is called a coupon. So instead of thinking of like a savings account issues interest, we think of a bond as issuing coupons. And there's some standard term. Usually 6 months, sometimes a year. And then at the end of the time for the bond, you earn back all the principal. So at the end of however long this bond was issued for, you give them back the piece of paper, they give you all the money back. That's called the time of that is called either the redemption date or the maturity date. And the value you get back for that principal is the redemption or maturity amount. So putting this all in the same sorts of terms, a single bond can be issued in a lot of different pieces so that you don't just get one person holding all of this debt to a city or a company or whatever. It's split up so a lot of different people can buy in. So formally, A bond is an interest-bearing certificate. Here's a piece of paper, and we will pay you interest this frequently at this percentage. If it's held by the government, it's called a public bond. If it's held by a corporation, it's a private bond. Amounts, the dates of the coupons, and the term must be specified when the bond is issued. It must be in the contract that is the bond itself. A government usually issues bonds through its treasury. So you'll hear the phrase treasury bonds, but you'll also hear treasury notes or treasury bills. These are all equivalent terms. They only differ by how long they're usually issued for. And so these are often abbreviated T-bonds, T-notes, T-bills. And it really depends on time. Bills are usually less than 10 years. Bonds are usually much bigger than 10 years. And notes seems to be a catch-all term. I can't quite find a particular framing for the time. Savings bonds. Usually they're labeled by one of two common prefixes. There are series EE bonds and there are series I bonds. And those type of bonds, you don't have to wait until the end of the term to redeem them. But if you redeem them early, they prorate the interest. If you redeem them late, they add on some interest. But a savings bond is a physical piece of paper. A treasury bond is a physical piece of paper in your hand. Used to be, now it's all an electronic transfer. So you get a computer account that says you have this much in your bond account. Once you have that, you can resell it, you can transfer it, you can give it away. Savings bonds are often given as birthday gifts on somebody's 0th birthday to save towards college accounts and things like that. Here, start your child saving now. You got them a social security number when they were born. Here's a savings bond in their name. And bonds can have different types of collateral or no collateral at all. So I can issue a bond against the value of my company. I can issue a bond on the assumption that I'm good for it. And if you believe I'm good for it, maybe you'll buy that bond. Which brings me back to the thing we were talking about on Thursday last week about risk. Talking about risk. Well, there's got to be somebody who decides how risky a bond investment is. Should you buy a bond from the US federal government? That assumes you believe that at the end of the term, the federal government will give you the money back. And there's a credit rating agency. There are 3 of them. There's Moody's Analytics. There's the Standard and Poor. Analytics. And there's the Fitch Analytics Group. And those are the 3 primary rating agencies in the world, and they assign risk levels to bonds. And if you go onto the Moody's website, you can see their definitions for what are the different categories of risk. There are a lot of subcategories. It's not just A, B, C. For example, there's AAA, AAA minus, AA, AA minus, A, and A minus. So there are really 6 A categories. Purchasers have to account for what the rating is, and a loss of principal is called a credit risk. Hey, this is a risky investment. You better pay me a little more to put this investment in place. That's what the coupons are for. That's the interest I'm earning. That's to pay me for the risk I'm taking on by giving you this money. And higher risk is usually associated with return on investment potential. If there's a higher risk involved, then I'm probably going to earn a little more. If there's a very low risk, I'm probably going to earn a little less. Joe, you've got your computer open. Can you go to the Treasury website? I think it's just treasury.org. There's a place where you can buy Treasury bills, Treasury Direct, I think it's called. There's a link on our Canvas page. Great. So here's the Treasury Direct, allows me to buy bills directly. And I can find out all the prices right here. What am I able to get? What are my rates of return right now? There you go. There's a Series E savings bond, a Series I savings bonds. 30-year notes versus bonds, right? Look at the time difference. So all of these ideas are calculatable right here. How to buy one, how to cash it, how to find the value, all sorts of different options. They moved away from doing physical pieces of paper. It's all done electronically now. I think this has only been within the last 8 years. But you used to actually get physical certificates. The savings bonds that were Series EE were this kind of orange, oversized, letter-sized piece of paper that you could physically give as a gift to a newborn. The people who want to take on the debt, they're the borrower, but they are the issuer of the bond. They're the seller of the bond. So all of those terms are interchangeable. Issuer, seller, borrower. Those terms all mean the person who wants the debt, who's asking for the money. So then we would obviously have the person who buys the bond, purchaser, buyer, the lender, or the bondholder. Because you gave them the physical piece of paper. So I have the person selling and the person buying. This is a contract. That's really all it is. It's a contract between two people. I give you this money today. You give me payments of this much on these dates and then return the money on this day. A straight term bond looks like an interest-only amortization schedule. And I pay back all of the principal at end of term. So, again, the terminology changes when the situation changes. So instead of calling it principal, we're often going to call it a face amount. Or face value. And then I need to have an interest rate. But the interest rate that we're talking about up here is going to be based off of what we were calling coupons. So this is called the coupon rate. Sometimes the bond interest rate, but more often it's the coupon rate. And then I need to know how long. Since we said the end of our term was our maturity date or our redemption date, I'll use those two phrases again to describe the term. And then how much you get back is the redemption amount. 99.9% of the time, redemption amount and face amount are the same, but not always. As a matter of fact, those Series double E savings bonds I was talking about, you have usually got two different ways of buying them. You can buy them at face value and get interest payments along the way, or you can buy them at half of face value and get no interest payments until the end, where you get, I pay $50, I wait the term, I get $100 back. Or I pay $100 and then I get interest along the way and I get $100 back. That's a difference in the way I figure out the coupons, and having no coupons in the interim, it's literally called a zero coupon bond. The United States and Canada both issue coupons on a 6-month basis. So our interest rates will be given semi-annually. It's like I2 with a little superscript there. But rates are almost always given as nominal annual rates. And then I have to remember to cut it in half appropriately. And the first coupon is 6 months after purchase. If the bond is bought on a non-coupon date, so let's say the date was already fixed, it was going to be June 30th and December 31st, and I buy the bond today, well, then I'm going to have to prorate the interest for that fraction of a period. Page 204. My textbook. This is what, on a particular day, we saw for bonds being issued with different terms, when they were sold, when they were redeemable at end of term, what the interest rate was. We'll talk about yield in a minute. And then they worked out a price, and this is an ID number, this CUSIP number. So that first line, that's summarized right here. I've got an interest rate of 1.25%, but a yield of 1.316. I beg your pardon. And then if I work out what's the price right now of a $100 bond, the price is 99.87 and fractions of pennies. They almost always go out to 6 decimal places. The website, I think, only goes to 4, but you can extend it. You can change the setting. Yield is normally higher as the term gets longer. If I'm going to loan you the money for 30 years as opposed to 2, I expect to earn more because you're going to hold on to my money and I could be doing stuff with it. Notice that isn't true here. The bonds that were issued in 2017, the 2-year bond has an a yield rate of 1.316 and the 30-year of 3.05. But in 2023, the 3-year bond has a 4% rate, 10-year has a 3.6, 30-year has a 3.68, so 3.7. What? What's going on here? Why would a shorter term bond be more valuable than a longer term bond? Just looking at these 3 numbers right here. 3-year, high rate, 30-year, lower rate. Why? Who does? So the government's in more need of money right now, and that means that we're not as sure they're going to be able to pay it back in the near term. So in this case, that high yield up front means people don't have faith that they'll get their money back in the short run. This is a statement about faith in the lender, the person issuing the bond. The higher yield means we don't trust you enough to give you our money if we're only earning 3%. I need to be earning 4%. I think you're riskier than that. I think you're riskier in the short term than I think you are in the long term. I don't have faith in you right now, but the institution overall, I think, is pretty good. So having a high short-term yield and a low long-term yield is backwards from what we think of as normal. A normal yield curve gets bigger as we go forward in time. An inverted yield curve is big at the beginning and lower at the end. It's problematic. We'll talk about this much more in detail a couple more chapters down the line about the way yield curves work and what we can read into them from a fiscal perspective on the health of what we're looking at. All right. Where'd this number come from? Where'd this number come from? According to this idea, I'm going to get how many coupon payments? This is a US bond. Coupon payments are every 6 months, right? So 6 months from May 31st to June to July to August, September, October, November. I'll get a payment November 2017. I'll get a payment May 2018. I'll get a payment November 2018. And I'll get my last payment May 2019. So I'm going to earn 4 coupons here. in a 2-year bond. Let's figure out what the time diagram looks like for this bond. Well, that means this is an APR, which means every 6 months, I should be earning 0.625%, right? But then they gave me a yield. And what's the yield number on this bond? Was just looking at that. 1.316. What's half of that? Okay. Let's pick a face value. I'll make my life easy. Let's do a face value of 100. So I buy $100 bond from this person on time 0. These are my coupon dates. They're in 6-month periods, right? So on this day, what do they pay me? Right. 0.625%. Same thing here, right? Coupon rate is the same each time. Then here, they pay me the coupon and they pay me back the $100. What's the present value? Now here's where the coupon rate and the yield rate are thought of differently. Because the yield rate is what I'm going to use to figure out the present value. The rate we had here, that's the coupon rate. That's how much each coupon is worth. So now, how do I figure out what the present value is? Let me break this last payment up. I'm going to think of it as 2 separate payments. One payment for just the coupon and another payment for the face value. Oh, wait a second. To figure out the present value, I just need to move the face value back here, right? So the present value takes the face value and moves it back in time. What goes in here? Unfortunately, no, that's the coupon rate. To get this, I need to use the yield rate. So it should be this number, but it's 1 plus. So it's 1.00658. What about the 62.5 cents? I got to take care of those payments now too, right? But that looks familiar. I'm getting the same payment every 6 months. Isn't that an annuity? That's exactly what an annuity is. It's a level payment annuity at that. How do I calculate the present value of a level payment annuity? I just gave you this back. Which one of my formulas do I use for a level payment annuity? Present value. Out come the formula sheets. Present value for a level annuity. I don't want a number. I just want to know what formula I should be using. We'll work out the number after this. To do an annuity, I need to know whether it is immediate or due. Which kind of annuity do we have here? Payments made at the end or the beginning? Say again? At the end. So that's an annuity immediate, an ordinary annuity. I'm calculating present value. That's this formula right here. That's AN with our interest rate. Got to get it tuned up for the weather. Since this annuity is 0.625 in value, it's 0.625 times A4, and then I need the rate, but the rate is this yield rate. Now I can actually work out the value of this. Fortunately for us, I can just do that calculation directly. (100 parentheses 1.00658) to the negative fourth plus 0.625, 1 minus 1.00658 to the negative fourth, all divided by 0.00658. Hey, wait a minute. I've seen that number before. I promise I didn't pull that number out of my ass. 99.870143, right? 870143. 99.870143. That's exactly the price we're using here. So notice there are two different rates involved. There's the rate we pay the coupon at, and there's the rate of interest that the principal is earning over this whole time. And that's why there are two different rates in this column. There's a coupon interest rate and there's a yield rate. All right, hang on. I need some notation to generalize this. I want to try and work out the price for any bond issued in this fashion. So let's generalize. F, face amount. R, coupon rate per period. So that means I've already divided by 2 in the case of semi-annual coupon issuance, like the US government, the Canadian government. Some bonds are issued with annual, some bonds are issued with quarterly, especially corporate private bonds, because corporations are required to return quarterly earnings reports. And if I'm going to publicly declare my corporate quarterly earnings, I might as well issue a coupon on the quarter, because I'll have a value and I'll be able to tell you what the coupon should be paid at. That is, by the way, currently under review. The federal government right now wants to change the requirements from quarterly reporting to semi-annual reporting. I'm not sure I agree, but a lot of business energy is spent doing the quarterly report. C is the redemption value, which right now we're going to assume is equal to F unless otherwise noted. We'll talk about why you would have a different redemption than face value later. And then N is number of periods per term. So in the bond we were just doing, our face value was 100. That was our redemption value. The rate for the coupon was 0.625. And the number of periods was 4. I'm going to give J as the yield rate per period. So we're going to use R and J slightly differently than we were using them last time. Let's think about what our time diagram looks like. I buy the bond on time 0, which I will assume is exactly 6 months before the first coupon. So I'm buying on a coupon date. If we go back and look at that table on page 204, that would be saying, oh, I'm buying, the issue date is May 31st. That's the day I buy it. The maturity date is May 31st. That's the day it comes to term. And it's going to be every 6 months. So I bought it exactly 6 months before the first coupon. We're not worried about fractional dates at this point. Notice that first column though says auction, sorry, second column says auction date. When governments issue bonds, they tend to say, all right, people, make me an offer. And they leave that for like a week or 2. In this case, 8 days. And that's where negotiation on yield rate and the terms of the contract come out, and people can then buy into that bond. So sometimes these are first offers and fluctuations happen and things get changed. So how much do I get paid on this day? You just want to generalize this time diagram. But how much do I get paid here? Except I need to multiply that by my face value, right? So that's FR. And I will get paid that coupon amount coupon rate times face value, that coupon amount, every period until the end. So those are my coupons. But I also have to redeem the bond at the end. So my redemption date comes around. I've reached the end of my term. What happens here? Well, I'm going to say I pay C, which should be F unless something weird came up. And I'm being a little anal retentive here. Almost always, face value and redemption value are the same, but we'll see reasons why they might not be moving forward. Okay. At time 0, what's the present value? Let's do it as two separate pieces, just like we did before. What's the present value of the redemption amount? I have to move the redemption amount back to time 0. So I take the redemption amount and I move it back n periods. But here's where the difference in interest rates comes into play. Because I don't move it back at the coupon rate, I move it back at the yield rate. We might also write this as Vj to the minus n. So to the n, sorry. Vj is 1 over, right? That's where the negative in the exponent comes from. Now, that's the redemption amount. What about the coupons? Oop. Well, the coupons are a level payment annuity. They're a level payment of FR. It's the present value, so it's A. And the yield rate, J, is what I'm using to figure out the value of that. This formula right here is in the textbook as number 4.1. We're going to use a lot, so put a mark next to that one. But the important idea here is that I've computed the present value 1 period before the first coupon is paid. That time 0 when the first coupon is at time 1. You're right, Adam, I really should think of F as being equal to C, and if I do that, then the present value, I just replace this with a C. Right? Let's do a little algebra. A N J is 1 minus 1 plus j to the minus n over j. Let's split up that fraction. Hmm. I see the same thing in a couple different places, don't you? So let's regroup. Wait, f 1 plus j to the minus n, 1 minus r over j. Yes? The r over j is here. There isn't one there. The f and the 1 comes out. We can rearrange this formula in a lot of ways. Let me take out the r for a second. If I cross multiply here, I can get rid of that j. Swap sides here. F 1 plus j to the minus n is f minus fj a n j. Oh, wait a second. Hang on a second. Let me go back up there. I had the present value was f 1 plus j to the minus n plus fr a n j. Well, now I can replace this term with this stuff. And I get f minus fj a n j plus fr a n j. Well, those have the a and j in common. Here's another way to write this equation. And now I see why the two different rates matter. Coupon rate versus yield rate. There's our rearrangement right there. I did notice a typo in the textbook right here. ANJ is 1 minus VJ to the N over J. They forgot the to the N. So please double check your textbook. Page 206, there's a little typo right here. So that's rewriting the 1 plus J to the minus N as VJ, writing our A and J in terms of VJ as well. Let's rearrange this. I've just multiplied out the FR. Oop, forgot the R here. But notice now, wait a minute, C was supposed to be the same as F. All right, let's put that back. I see FVJ to the N here. I see FVJ to the N there. What is FVJ to the N? What is this first term again from our time diagram? This piece? Where did we get that piece from?
That's redemption amount.
The present value of our redemption amount. Absolutely. It's the present value of our redemption amount. Let's give that a name. K equals F VJ to the N. Present value of redemption amount. If that's the present value of our redemption amount, then this expression is K plus FR over J minus K R over J. Or K plus F minus K R over J. So here are 3 different versions of the present value formula. And by the way, I typically end up using, to calculate our present values, I typically end up using which version? The one we started with is our definition. This one. That's the way I figured out present value for our example. This version, by the way, has a name. It's called Makeham's formula. Again, in the table, we were talking about getting that value. They made a copy error here in the textbook. They copied over the incorrect value. I think they just didn't update this between the 7th and 8th edition. So on page 207, they have the wrong date and wrong interest rates based on the problem we just looked at. Let's do another bond issue. Now, if I'm the city of Pittsburgh, it makes perfect sense to me to want to borrow a crap ton of money to do stuff in the city of Pittsburgh. Don't you think? There's a lot of stuff needs some work in Pittsburgh. So let's issue a bond. We're going to issue a bond with a coupon rate of 10%. A term issued June 18th, 2010. First coupon is December 18th, 2010. And the face value is $100 million. Oh, and we'll make it a 20-year bond. So the term is 20 years. Redemption date Six 2030. This is why we break bonds up into lots of little pieces. I don't think anybody is going to buy the whole $100 million loan to the city of Pittsburgh, do you? But you might buy $1,000. If you're a company, you might buy $10,000, $100,000. You might even buy $1 million. A guarantee bond. What I did not give you yet, that's an absolute necessity in order to figure this out, is the yield rate. I want to do this calculation 3 ways. Let's suppose my yield rate could be 5% or 10% or 15%. I'm going to use this version of the formula. So let's hang on to that one off to the side here. If yield rate on this bond is 5%, what do I get as a price for this $100 million debt? How much should you pay today? Okay. Notice in this formula, I can take the F out. And do the rest of the calculation in the parentheses there together. R is the coupon rate per period, but by law, it must be given as an APR. So when I say up there, it's a 10% coupon rate, how much do you get each coupon period? You get exactly half of it. And the same thing is true with the yield. J is the yield rate per period must be halved as well. So when I work out at 5% yield, my present value is 100 million times 1 plus point coupon rate first, yield rate second, AN. How many coupons are going to be issued in the term of this bond? Because it's 2 a year. And then J is the yield rate. Grab your calculators, calculate for me. By the way, this is quite frequently where round off errors kind of get away from us because we're looking at really, really, really big numbers with a face value of $100 million. So I want to keep a lot of decimals in this process. Notice I get some nice canceling going on here. Give me a number.
Um, 937.6.
Hey, wait a minute. The bond is only for $100 million. Why am I paying more than that? Promise there's a good reason to be paying more than this. Why am I paying extra for this bond?
It's a long time.
Unfortunately, no, the length of the term isn't a good enough reason just to have the price go up. Let's do the other two calculations. Let's see what happens if we change the yield rate. So what happens if my yield is 10%? Wait a minute, that's an APR. So J is 0.05, right? The coupon rate doesn't change. The coupon rate is fixed in the bond. So here my present value is 100 million times 1 plus R minus J. Wait a minute, R is 0.05, J is 0.05. I don't even need to calculate this, do I? Multiplied by 0. This present value is exactly $100 million. Okay, hang on a second. I think I see what happened here. But let's do the third one just to be sure. In the third one, the yield is 15%. So J is 0.075. What happens with this calculation? Work this one out. Give me a number.
$68,113,000, sorry. 13,970.34.
Okay. What I see here is that the present value goes down as the yield goes up. Remember, the yield rate is the interest rate we're earning on the principal. The bond is going to pay me 5% interest every, sorry, 2.5% interest every 6 months. No, 5% interest every 6 months, right? The bond rate was 10%. So wait a minute. What's 5% of $100 million? I get $5 million every 6 months. If I buy this whole bond. First of all, I'm not going to be able to buy the whole bond, but we'll run with it for the moment. If I buy the whole thing, they're going to have to pay me $5 million in 6 months. But they can only earn 2.5% 6 months. So where do they get the rest of the money to pay me? From the extra money I paid them for the bond. Here, they earned exactly $5 million in interest. That's what the yield is. Then they pay me $5 million. Here, they earned more. So they can still pay me my $5 million with a smaller principal investment. The price goes down because the coupon rate is different than the yield rate. And as yield goes up, this gets cheaper. Back here, they were going to pay me 10% bond, but they're only earning 5%. I'm making more money than they are. There's a premium associated with earning that. This bond is exactly the same as its face value. That's called a bond at par. And then this bond, down here at the bottom, they were earning more. So they got to charge me a little less. They got to ask for a little less. That's a nice deal. By the way, remember, this bond is a physical object. I now have pieces of paper, electronic transactions, whatever they are, that say you're entitled to this coupon every 6 months for whatever fraction of this I actually bought. I could sell this at any point in time.
So, the coupon is what they're giving me.
That's
and the
the,
yield is like what they're charging, what they're getting.
in a sense, yes. The yield is what they expect to earn over the term of the loan.
They being the borrower,
The-
the lender.
The lender, yes. So you just loaned, I just loaned you money. I gave you this amount. You promise to pay me 10%, 5% every 6 months for the next 20 years. If I can make 15% on my money, then I'll be able to do that for a very low price, won't I? Exactly. So the yield is an expectation of what I think is going to happen in the future for me to be able to pay you the things we've committed to live up to the contract. Normally, I wouldn't do this in value fractions of $100 million. I'd do this in hundreds of dollars. The prices are given, price per hundred. Some reporting agencies only keep 3 decimal places. Some keep 6, as the table we saw at the beginning of the text. And it's a very different behavior. But I could sell this. The textbook on page 207 has me sell this on June 18th of 2020, right after the coupon is paid. Wait a minute, let me back up. I issued this on June 18th of 2010. If I sell it on June 18th of 2020, how many payments are left? So I could figure out the present value of the remaining payments plus the principal at each of these yields. And then I'd know how much to sell this bond for. December is coming up. I could say I want to sell this December 18th of 2025. If I do that, then there are 10 payments left. And I could figure out, 9, because I'd figure out after the payment was made. And I could figure out exactly how much I should sell this for on December 18th of 2025. This is a transferable asset. I own this bond. I can sell it to someone else. There is another listing that sometimes comes up called the current yield. This is primarily for not government bonds, but for corporate bonds. And it is the coupon divided by the price. Which means I have to work out the price and then figure the coupon rate against it. So the first bond, I paid extra. That's a bond purchased at premium. The middle bond was at par. And this last bond, I got a discount. So you can buy a bond at a premium, or you can buy a bond at a discount, or you can buy a bond at par. I wrote par on the one that was at par. So this one is at a discount. And this one back up here was at a premium.
Is the yield rate based on the inflation?
And stability predictions and general economic trends, yeah. And that's part of why having a normal yield curve where there are low yields at the front in short terms and larger yields in longer terms is a sign of a healthy economy. And having an inverted yield where I need a higher yield in short terms and a lower yield in long term is the sign of a potentially sick economy. There's a lot of forecasting based on bond rates that goes into setting that yield rate. And that's why I wish I could say this every single bloody day. The 10-year Treasury note rate is reported because they're estimating what they think is going to happen in 10 years. And they're saying, oh, our economy seems to be doing this, so we're going to lower the rate because we think more people are willing to lend us money for 10 years. Or we're going to raise the rate because we think we have to pay more to get people to loan us money for 10 years. That is one of the primary jobs of the Federal Reserve. And that's why every evening at 6:30, the marketplace report talks about what bond rates did that day. There's a lot more to bond rates. A lot more valuation. What happens if I don't have the the right date, if I don't buy it exactly on the proper date? What if I am looking at the premium and discount behavior? We'll look at that more on Tuesday. A reminder, your chapter 3 homework is due on Tuesday. And, I'm sorry, yes, chapter 3 homework. And the exam for chapters 2 and 3 is a week from today. I'm writing it this weekend. So I will see you all then. Remember, you're allowed a formula sheet. You can add on to the one you were previously using, or you can write a new one, and you'll get the actuary sheets as well. I will see you all then. Have a wonderful weekend.